Oh, hi, George. Thank you so much for joining us. Wasn't sure it was going to happen. I reached out to you on Twitter. I want to thank you for responding to me, and I always like to start at the beginning, George. Why don't you tell me how you got involved in the trading industry and if you yourself had mentors and who you work for now? But let's start at the beginning. Who do you blame for you getting addicted to trading?
Yeah, so I went to Duke University. I was there for 4 years, and in the course of my education there, I sort of discovered the financial industry as a lot of Duke grads end up on Wall Street.
I
Uh,
thought a lot of Duke grads ended up in the NBA.
yeah, there are a few of those too, and now the NFL as well. I was a football
Yeah.
player, and I now have 7 teammates in the NFL. So
Oh, that's
good
right.
to
I
see
read.
that.
Yeah. What did you play?
I was a walk-on tight end and fullback. So
Okay. Well, I'd rather have you as a friend than an adversary. So
yeah, yeah, I
it's
think
nice
that's
to meet you. So
yeah, likewise.
From Duke, what happened?
Yeah, so I did an internship, a couple internships during my time at Duke. I was at Bank of America Merrill Lynch for the summer of 2011. So debt ceiling crisis and Europe fears really reaching a fever pitch, and that sort of experience was a fascinating entry into the industry. And as interns, I mean, the process is you do 10 weeks, and after the 10 weeks, you figure out if you got a full-time offer or not. And actually, the process really hasn't changed much from when Michael Lewis wrote Liar's Poker. If anyone's read that,
Yeah.
there are some very real changes to the industry. But as far as the nervousness of whether you got an offer or the offer you wanted, those haven't really changed much, believe it or not. So
You
since the
know what else? You
1980s.
know what else, George, hasn't really changed in the industry? Is that most guys at Merrill Lynch and B of A Wealth Management have no idea about how to trade the markets. They're mainly asset collectors and salesmen, and they have a formula. And you know what they're going to say again if this market comes undone in the next year or so? Well, we were diversified. We're long term. And I'm curious, what did they have you do during your internship program? Make cold calls for a
Oh
broker
no,
to talk to
yeah,
you?
no. So the internship I did was on the institutional side, which is very, very different from the sort of thundering herd
Okay,
sort
so
of
then you were
popular
on the
perception.
desk.
Yeah, exactly. So I spent 10 weeks. I guess I rotated through interest rate sales, mortgage-backed security trading, and sales, and then I also spent time in futures. So very macro-oriented, and it was quite something to sort of see the gap between the sort of popular perception of how a lot of things go on trading desks and the actual reality. That was a sort of a big realization for me that finance is a lot of numbers and a lot of math and a lot of sort of cold analytical thinking, but the human side of it is also very, very real and very important to keep in mind. So that was quite an experience. And after that, I did get an offer, and I was at B of A Merrill for about 15 months until the end of August, or end of 2014, or sorry, end of 2013, excuse me. And since the beginning of 2014, I've been at Bespoke Investment Group. So I'm primarily a research analyst with a focus on global macro here.
Okay, so global macro, what a great topic. Plenty of
It's
global
broad.
macro.
It's broad. I'll say that
Yeah,
about it.
well, and it's also relevant because a lot of what's happening to the U.S. market's a result of what's happening globally, the commodity weakness, people attributing this to China and deflationary aspect of lower commodity prices, lower oil prices. What's your view? Are the U.S. markets overreacting to what's happening with the yuan devaluation and the Chinese market and the Chinese seeming to lose control of their market and arresting people instead of letting free markets find their levels?
Yeah, so I think there's a lot going on in U.S. equities right now, and I think it's been true for quite some time that U.S. equities themselves haven't really been the driver of the boat for global markets. And I think that was true before we saw, sort of the sharp declines that started in the back half of August. My view is that U.S. equities are much more about positioning and about a reassessment of risk premium than about some sort of comment on the indefinite direction of the global economy or especially the U.S. economy. I think there is a big disconnect that we've seen between domestic U.S. economic data and stock prices, and there's no reason that the stock market really isn't the economy, so that shouldn't necessarily surprise anyone. What I would say is that we've seen a lot of indications that the phenomena that have gone on in the last couple of weeks, everything from the conditions at the open on Monday, massive gaps and massive net asset value mispricings of ETFs, Rule 48 being put into effect regularly on the NYSE, just out of this world intraday volatility relative to what we've experienced in the past.
Well, what, George? In the past, we had people there. You look at any exchange now. I've been back to Chicago. They're bowling alleys. Okay, so because computers have taken over, in my career, it was a person that was a liquidity provider on the floor, and they're not there. Do you think that's part of it? The structure of the trading now?
Yeah, so I think when you're talking about machines versus people, right, with regards to market making, there are trade-offs with each. I think that in the short term and for small position sizes, machines have been pretty demonstrably proven to be better at providing liquidity, frankly. The problem comes when you get large standard deviation events like the one we went through last Monday. And I have a friend who's an advisor for another firm who was able to arbitrage an S&P 500 ETF to the tune of 10% by hand, executing orders through his firm's brokerage platform. That just shouldn't happen, right? You shouldn't be able to do that. And the reality is that, when we do see these sort of extreme imbalances in the market, the machines are just not as good. And this is a broad generalization, I realize, but I think it's a fair one, that the machines are just not as good at providing liquidity over anything but very short time spans. And my view on it is that that's not necessarily a bad thing. I think some of the imbalances that were visible at the open, again, using last Monday as the example, they righted themselves. By the end of the day, everything was trading right in line with where it should have been in terms of, for instance, the value versus underlying in ETFs or so on and so forth. But if you...
Yeah, but that didn't help the people that had stops protecting themselves that got picked off with illiquidity at terrible prices. And
Sure, but
recovered.
The reality is, though, if you're relying on an automatic stop, you're exposing yourself to risk, right? Execution risk is a very real thing, and it would be nice if any ETF or currency, the Swiss franc devaluation back earlier this year would be an interesting example as well. It would be nice if any of those instruments could trade in a perfectly continuous world where second to second the same liquidity was there as the last second and there were none of these gaps. But the reality is the world doesn't work that way, and human nature and positioning play big roles there. And so I think when you combine those together on an intraday basis, I just don't think that you can rely anymore on automated stops and extremely tight NAV discounts and good liquidity and futures and FX and so on and so forth on an intraday basis. For a long-term investor, for someone that's looking at their retirement 10, 20, 30 years away, I don't think any of this matters. What it matters is for the sort of folks that are probably watching and listening right now, who are executing many times a day, who are deeply involved in the sort of back and forth intraday of the market. It's just a new risk factor you need to be aware of.
I think that stop losses are appropriate not just for day traders. So if you can't count on stops for risk management, what do you tell people to do as far as risk management?
Our view is that automated market stop loss orders are not something that anyone that's in the market, anything less than tick to tick, should be using. Unless you know exactly where something's trading intraday, if you've got a market stop in, you're exposing yourself to the sort of thing that happened last Monday, and that is exactly what happened last Monday. Is that there were so many people who had either hit automated stops or said on Sunday night, well, I got to sell at the open on Monday morning. If you're using an automated stop, you're exposing yourself to risk. There's really no other way to put it, and I think that would have been true at any time previously. I just think that the current market environment is making it abundantly clear. So our advice to clients is that if they're going to be using stops, if they're going to be saying, okay, well, if my position in this ETF or this single name stock or whatever their position is, if it reaches a certain level, I'm going to stop myself out, I'm going to exit the position. That's fine, and that's absolutely how almost everyone should be trading, especially in an active sense. But the thing is, it's going to require a little bit more work than just having a market stop set. You need to be using limit orders. You need to be seeing how stuff trades when you execute, and that means that people are going to have to spend a little bit more time on the risk management.
Okay, so there is no alternative.
No alternative to
having stops for risk management.
I think that any position, the way I look at risk, any position, you should know a level that you have to get out at. That is, the sort of basic of risk management, is that the most you can lose.
Instead of placing a physical stop loss order, and I'm not sure if you could do it in equities, in futures, you used to be able to have a stop and then a limit. Okay,
right.
So it couldn't
exactly
kill you at any price. So maybe stop limits. What you're saying is that people have to monitor it without a stop in there, and it violates a level that they predetermine they should get out. You know what I call that? A mental stop. So
right.
Okay, well, let me tell you something. In Forex, the last time I used a mental stop, they dropped me off at a mental institution. So it's really a pretty difficult environment if you can't manage risk, because who can be at their platform 24/6, 24/5 to know that a market's taking out a level. So I think people have to realize now that there is pretty much unlimited risk because of situations that happen. Do you think that's a one-off in a week ago last Monday, or could that happen again?
So I would not describe it as unlimited risk. The ultimate sort of black swan event that we've seen this year, I would say, relative to the volatility in the underlying asset class previously, would probably be the Swiss franc devaluation. The risk there was massive, but it was not unlimited. The way you get to, it may have been enough to significantly damage a number of people's financial situations, and the losses were massive. But
are you kidding me? FX firms went bankrupt that day.
Right,
so
but
it wasn't just individuals; there were huge.
Sure, of course. My broader point, though, is that there is, nothing can go through zero, right? The unlimited risk is not how to describe it.
Except your equity.
Right. Well, yes.
If you're
leveraged, yes, absolutely.
Right.
Which is a useful lesson in and of itself. Of course, the upsides and downsides of trading on margin. My broader point, though, is that it's not a question of unlimited risk. The way I would describe it is a situation where risks are elevated in terms of execution and liquidity, and if you're not capable of managing those risks in a given market, whether it's equities, whether it's FX, whether it's futures, it's really not important. And you don't think, if you think that, well, okay, I either have to be on my phone 24/6 watching levels to make sure I can get out at a right price point, or I'm exposing myself to too much risk. Well, I think that you would have to take a step back in that situation and say, okay, hold on. If the only way I can manage my risk is to be that close to the market at all times, is this actually the right amount of risk for me to be taking? And that's, the answer to that's going to differ significantly from investor to investor. But I think that if you're in a situation where your leverage and your sensitivity to volatility and to specific levels is that high, it's time to take a step back and start saying, well, how much risk am I running relative to the reward I can get for it, and am I able to sleep at night? And
Beautiful.
If you're not able to sleep at night, you're not going to be trading.
That's it. That's a sleep factor. That's a pearl, George. For a young man, that's a pearl. If you're losing sleep over positions, you're overcommitted.
Right.
What are you telling your people at Bespoke as far as some of the asset classes here? Are you guys viewing this as a correction after a long-term bull market and looking for a resumption of the bull, or is with certain trends, are trends reversing and this could be a very deep correction? A lot of stocks are already trading, most of them in correction territory, some of them in an arbitrary number. People say 30%. You're in bear market territory.
Yeah, the measure we use is off of a previous high. A 20% decline is a bear market. So I believe, I can't remember off the top of my head, it's something like 30%, or maybe I'm probably getting that wrong, and I'm sure one of your sharp viewers will pick me out on this. But a large chunk of the S&P 500 is already in a bear market, as far as a decline of 20% or more from its previous high. As far as the market as a whole, I mean, it's very rare, historically speaking, to see an equity bear market, so that is a decline of 20% off the previous high, in a economy that's expanding, and in a strong U.S. economy. Is it possible? It's absolutely possible, and we would make no claim otherwise. But the reality is that it's rare. So I think for the folks that think, oh well, the last 5 years of equity market gains, or the last time we came close to a bear market was 2011. So the last 4 years of equity market gains, or wherever you want your starting point to be, right? I think that the folks that say, okay, well, we need to give all that back up now, we're going to enter a new bear market. Albert Edwards from SocGen has proclaimed that we're in a bear market and every new high is to be sold and every new low is just more to come. I think the burden of proof is on them to show that we're seeing something other than a positioning clear out here. The economics in the United States, and granted the S&P 500 exposure to the broader world is much higher than it has been historically, but the economy in the United States is, we can't see anything wrong with the household and consumer economy. We see pressure on a manufacturing sector that's a tiny weight relative to its historical value add in terms of U.S. GDP, and we see pressure probably isn't saying it strong enough, but real problems for energy, and those two factors are probably going to continue. So what we would expect is that the energy sector and manufacturing are both going to continue to hurt, and we'll see bounces and recoveries and sort of sideways action maybe a lot of the time, but at the end of the day, that's not true of households. The construction spending report yesterday showed the highest year-over-year growth in construction since the last peak in that measure, which was the peak in construction spending back in 2006. Nominal construction spending is up 14% or 13.8% year-over-year. And that's with private residential spending, so basically building houses and apartments. That is less than half, or about half of its historical peak. So the tailwind to the housing.
So there's still a runway there for housing.
There's still a massive runway. Right now, the contribution to GDP from residential fixed investment, so the private residential fixed investment, is sitting at historical lows relative to previous recessions. So that share is right where we previously would have seen a recession low. And housing has historically been very cyclical in the United States. So the recession lows are the lows for any given cycle. That is only now, after 4 years of recovery, reaching recession lows, previous recession lows in a number of different cycles dating back to World War II. Population continues to grow. The United States demographics indicate that we're going to need more houses. We don't have enough houses, whether it's single family, whether it's multifamily. So our view is that with labor bargaining power looking tentatively to be rising, with a lot of very green shoots as far as wages go, housing continuing to do well, and households that are much more levered to their home equity than to the stock market in aggregate. Our view is that there's no reason to be concerned about what's going on in the services, the household, and the consumer economy in the United States. And I would mention also, we're looking at a lot of stats that look a lot like 2007 with one big difference. Instead of decelerating, they're accelerating. And two large differences. Instead of decelerating, stats are accelerating. And instead of coming with higher household debt, they're coming with lower household debt as a percentage of GDP. And all-time lows, effectively, for interest expenses or percentage of disposable personal income. So,
well, you're sure building the case for Yellen to move in September, George. Should she, and do you think that she will?
My view on September is that from an inflation perspective and from an employment perspective, it's probably not strictly necessary to go. I think they should go, and the reason for that is one of psychology. I think that we're pretty close in terms of the leading indicators for what looks like to be a pretty robust inflation cycle in the United States 5 years forward. I think we're really getting there. If you look at how CPI is constructed, we're seeing a number of service and housing-based indicators of inflation running at 3% year over year and accelerating. So, looking forward, we see sort of the core drivers of U.S. inflation to be ready to go. They're not there right now, and that's largely because of the dollar and oil. But I think that, I really do think the committee should look past it and say, well, if we don't do it now, when the consumer looks so strong, when the stock market has already priced in a lot of negative news around the increase in the risk-free rate, when the dollar is already so strong versus where it was 18 months ago, when are we going to do it? We've seen sort of the worst that the dollar can do to our manufacturing sector, and that coupled with a massive decline in the price of oil that's added fuel to the fire, and the U.S. economy has basically shrugged, whether it's job growth, whether it's income growth, whether it's consumption growth. Certainly those stats could have been stronger if manufacturing had continued to accelerate as it did in 2014 before the dollar took off. But the reality is goods as a percentage of GDP, or value added for goods as a percentage of GDP, is something like 11% versus 89% for services. The U.S. economy is much, the household and what goes on in employment markets is much more important for the U.S. economy than anything that goes on in terms of trade of goods overseas. And so our view is that, or my view, I should say, my view is that that gives the Fed cover to move and to get out of an extraordinary emergency policy situation.
Okay, a very informative interview, George. I'm so glad I reached out to you on Twitter, and a lot of wisdom for not that many years at your game. I just can imagine what kind of analysis is coming in your future. So I want to thank you. What's your most precious currency, George?
Precious as in, which am I most bullish on?
Your most precious currency in your life.
Oh, in my entire life. Okay, I'm sorry.
That's okay.
Definitely, without doubt, it would be people. I'm surrounded by awesome people,
Cool.
at work, in my family, my friends. They're, that is the true currency of life, in my opinion, and it is one that can't be traded for any of the paper or digital stuff that we punt around. Right.
Well, I think your perspective will change in maybe a generation or so, and people are always going to be, when later in life, when you're thinking about your life, you're not going to be thinking about your best trades. You're right. You're going to be thinking about your relationships. That's our goal. But my most precious currency is time, George, and I want to thank you because money comes and goes. Time is gone forever. If you want to trade ages with me at any time, get a hold of me on Skype and we'll do it. And I want to thank you so much for edifying our community and wish you nothing but success in your career.
With pleasure. Thank you very much. Have a nice day.
All right, George.
Bye-bye.
Ciao.